I have this doctor. He worked for Fidelity, and the 401k was at Fidelity. And he went to Fidelity and said, hey, I need to roll over my 401k. And it had about $3.5 million in it. So it was a big 401k. And when he said, sure, we can roll it over. You already have an existing IRA. We'll just drop it right in there. And he did that. And everything went smooth, easy. They allocated. Everything was fine until the doctor listened to the radio show. He comes to the office, and we sit down and have a conversation. And we're looking at his 401k, and we're talking about it. And he's explaining to me that he needs to take out $300,000 cash from this IRA. And he's going to buy a house. And we start talking about, but if you take all this money out of the IRA, you're going to pay tax on it. So we need to think about how that's going to work. And maybe we want to do it strategically. And then he says to me, oh, I don't need to worry about that. I've been making contributions to my IRA for decades and have non-deductible contributions I've made. And I must have $400,000 or $500,000 of after-tax dollars where I never got a tax deduction for putting into the IRA. Well, we got a problem now, because when you look at the IRA, it doesn't tell you that. So I asked him for the forms. There's IRS forms you have to file every year. Whatever CPA he was using in the past had never filled them out. And I'm not going to blame the CPA for that. Maybe the doctor didn't tell him about it. But nevertheless, we have this huge basis in the IRA. But wait, just like Ginsu knives, it gets worse. Right? He's thinking he's going to take out $400,000 and call it a day. Well, that's not how it works. Once he co-mingled it, we have a nightmare. We have an absolute nightmare. It took us a year to clean the money. Literally had to have him go back to work, set up a 401k. We had to roll all his pre-tax dollars out of his IRA into a 401k so that we could have his after-tax dollars still left in his 401k so that we could then get the after-tax dollars out. Because if he took it out while they were co-mingled, huge tax bill, can't get the money out. The problem is he did not have somebody who truly understand the tax implications of the recommendations that were being given.